In the depths of cyberspace, as the 20th century rolled into the 21st, a technological revolution was quietly brewing. Picture the internet landscape of the late 1990s and early 2000s. The World Wide Web had just begun to weave itself into the fabric of our daily lives, hinting at the global transformation it would soon bring. Amidst this digital revolution, a select group of tech visionaries began to imagine a new kind of currency, one not controlled by banks or governments, but by the very people who used it. This was the dawn of the age of digital currencies. Before Bitcoin was even a glimmer on the horizon, there were other pioneers who attempted to create their own digital currencies. One such early endeavor was B-Money, the brainchild of Wei Dai. Launched in 1998, B-Money proposed a decentralized system of money, governed not by central banks, but by complex cryptographic protocols. Each transaction in the B-Money universe would be broadcast to all its participants, ensuring transparency and veracity. At around the same time, Nick Szabo, another tech maverick, put forward a similar concept known as BitGold. His vision was to create a digital currency that could not be created out of thin air like conventional money. BitGold would require users to solve cryptographic puzzles, mimicking the physical effort required to mine real gold. These innovative attempts at digital currencies were driven by a common desire, a desire to democratize finance, to wrestle control from central institutions and return it to the hands of the people. They aimed to solve the inherent problems of trust, inflation, and control that traditional currencies grappled with. But why then did these early digital currencies fail to gain traction? A large part of it was due to the technological limitations of the time. The internet infrastructure was still in its infancy, and public trust in the nascent cyberspace was low. Add to this the lack of regulatory frameworks for such currencies, and the task of gaining widespread adoption seemed nearly insurmountable. And yet, these early digital currencies were far from failures. They were the technological stepping stones that paved the way for Bitcoin. By attempting to solve the problems inherent in traditional currencies and facing the challenges of the digital world, they set the stage for the more sophisticated cryptocurrencies that would follow. They taught us valuable lessons about security, decentralization, and the public trust necessary for a digital currency to succeed. As the world was still digesting the groundbreaking ideas from B-Money and BitGold, out of the shadows emerged a mysterious figure, a pseudonymous character that would come to be known as Satoshi Nakamoto. Nakamoto planted the seed for the future of digital currency in October 2008 by publishing an impactful 9-page document, the Bitcoin White Paper, titled Bitcoin, a Peer-to-Peer Electronic Cash System. Satoshi Nakamoto's white paper was a roadmap to a novel financial ecosystem. It proposed a decentralized system where transactions could occur directly between parties without the need for a financial institution, a concept that rang familiar to the ideas of B-Money and BitGold. But Nakamoto took it further by introducing the world to a new kind of technology, a technology that would become the bedrock of Bitcoin and later countless other cryptocurrencies, the blockchain. The blockchain is a public, decentralized ledger of all transactions across a network. This digital ledger is divided into multiple blocks, each block containing a list of transactions. These blocks are linked through complex mathematical algorithms, forming a chain of blocks. A blockchain. Blockchain technology was Satoshi's novel solution to the thorny issue of trust in a decentralized system. Within the white paper, Nakamoto also addressed the double spending problem, a significant obstacle in the path of digital currencies. Simply put, the double spending problem is the risk that a digital currency can be spent twice, a flaw that could potentially devastate trust in the currency. Nakamoto proposed that transactions should be verified by a network of computers or nodes, which would use computational power to solve complex mathematical problems and validate transactions. Once validated, these transactions would be added to the blockchain, effectively solving the double spending problem. With the white paper as the blueprint, Satoshi Nakamoto put theory into practice. In January 2009, Nakamoto mined the first block of the Bitcoin blockchain, known as the Genesis block, or Block 0. This initial block marks the official birth of Bitcoin, but it also carries a symbolic message. Nakamoto embedded a poignant headline from the Times newspaper within the code. The Times 03 Jan 2009 Chancellor on brink of second bailout for banks. This note was more than just a timestamp. It was a powerful commentary on the state of the financial world at the time. In the midst of the global financial crisis, Bitcoin, a currency free from the control of banks, was born. Just over a week after mining the Genesis block, Nakamoto performed the first Bitcoin transaction. He sent 10 Bitcoins to a man named Hal Finney, a noted cryptographer and ardent supporter of the Bitcoin concept. Finney, one of the earliest adopters and contributors to the Bitcoin network, played a vital role in nurturing this nascent technology, as did other developers and enthusiasts who joined in these pioneering days. Growth was steady, but Bitcoin was still far from the public eye. This changed in 2010 when the first Bitcoin exchange, named Bitcoin Market, was established, providing a platform for users to trade Bitcoin for traditional currency. This was a game changer, marking a significant milestone for Bitcoin's acceptance and recognition. However, the early days of Bitcoin are perhaps best remembered for a certain pizza purchase. In May 2010, a Bitcoin enthusiast named Laszlo Hanyecz decided to test the real-world value of his digital assets. He famously bought 2 pizzas for 10,000 Bitcoins. Back then, the transaction was worth about $41, but today, those pizzas would cost a staggering amount given Bitcoin's rise in value. Yet Hanyec's pizza purchase was about more than just the pizzas. It marked one of the first real-world transactions using Bitcoin, giving a tangible value to a digital asset. It brought Bitcoin out of the realm of theory and into practical use, setting the stage for a future where digital currencies could be used for everyday purchases, just like traditional money. In the early years following Bitcoin's inception, its price fluctuated modestly, attracting a steadily growing community of innovators and early adopters. Then, in 2011, an historic event occurred. Bitcoin reached parity with the US dollar. This moment marked a significant milestone, legitimizing Bitcoin's monetary value in the eyes of many and sparking an explosion of interest. As interest grew, so did the forces shaping Bitcoin's trajectory. The digital currency landscape was a wild west of sorts, and like any frontier, it had its fair share of outlaws. Silk Road, an infamous online black market primarily using Bitcoin for transactions, was one such entity. While the platform demonstrated the practical use of Bitcoin, it also cast a long shadow on its reputation, painting it as a tool for illicit activities. This negative perception was further amplified when the FBI shut down Silk Road in 2013, causing Bitcoin's price to nosedive. But Bitcoin was nothing if not resilient. Following Silk Road's shutdown, it bounced back, bolstered by increased attention and growing acceptance among businesses. This resurgence led to Bitcoin's first major rally, with prices skyrocketing to over $1,000 by the end of 2013. For the first time, people were witnessing the true potential and volatility of Bitcoin's value. As much as the Silk Road saga represented Bitcoin's resilience, the Mt. Gox debacle highlighted its vulnerability. Mt. Gox, a Bitcoin exchange handling over 70% of all Bitcoin transactions at its peak, suffered a catastrophic hack in 2014. This led to the loss of approximately 740,000 Bitcoins and the subsequent bankruptcy of Mt. Gox. The event shook the community, casting doubt on Bitcoin's security and sending its price into another downward spiral. Fast forward to 2017, a pivotal year for Bitcoin. It began with Bitcoin recovering from its post-Mt. Gox slump, and ending with an historic rally that saw its value peak at nearly $20,000. Many factors contributed to this meteoric rise, but one of the most significant was the introduction of Bitcoin futures trading, allowing investors to speculate on Bitcoin's future price. The mainstream financial world was now taking Bitcoin seriously, further driving its value. But as history had shown, what goes up must come down. And Bitcoin was no exception. At the end of 2017 and the beginning of 2018, Bitcoin experienced a crash reminiscent of the dot-com bubble burst. Its value plunged dramatically, causing a crypto winter that lasted for over a year. However, Bitcoin, ever the phoenix, rose again. Each time it crashed, it managed to claw its way back, gaining more traction, more acceptance, and becoming more resilient. In many ways, these cycles of boom and bust have shaped Bitcoin, testing its mettle, revealing its flaws, and inspiring ongoing improvements. In the Bitcoin story, today is a chapter defined by mainstream acceptance, regulatory challenges, and the wide-ranging impacts of this remarkable innovation. There's no denying that Bitcoin's march into the mainstream is well underway. Over the last few years, we've seen a wave of major corporations embracing Bitcoin. Companies like Microsoft, PayPal, and Tesla have not only accepted Bitcoin as a form of payment, but also integrated it into their financial strategies. These corporate behemoths' seal of approval has been a significant boost, opening doors to widespread adoption and recognition. Simultaneously, we are witnessing a surge of interest from institutional investors. Hedge funds, pension funds, and endowments, traditionally conservative in their investment strategies, are now exploring Bitcoin as an alternative asset class. This shift has accelerated Bitcoin's acceptance and legitimacy, providing further proof of its staying power. Yet the road to mainstream acceptance hasn't been without obstacles. The fluctuating value of Bitcoin and other cryptocurrencies has raised regulatory eyebrows worldwide. Governments and financial institutions are in a continuous tug-of-war with Bitcoin, attempting to reconcile its decentralized ethos with the demands of financial order and control. Cryptocurrency regulation has thus become a hot-button issue, with countries charting their unique paths, ranging from open embrace to outright bans. Bitcoin's role in economies experiencing financial crises or high inflation cannot be overlooked either. In these instances, Bitcoin has often served as a hedge against monetary debasement and a means of circumventing capital controls. This use case has added another dimension to Bitcoin's global impact, illustrating its potential as a stabilizing force in volatile economies. Innovation and adaptability have been the hallmarks of Bitcoin's journey so far. Today, we see that spirit alive and well in the form of the Lightning Network, an ingenious solution that's looking to scale Bitcoin to handle millions of transactions per second, or in the rise of decentralized finance, where Bitcoin is being used to build financial systems that are open, transparent, and user-controlled. As we look towards the future, it's clear that Bitcoin is not just a new kind of currency, but a catalyst for a new kind of world. A world where financial power is decentralized, where transactions are transparent and verifiable, and where financial systems work for the people. But this future isn't without its challenges. Privacy concerns, scaling issues, and regulatory uncertainty are but a few of the hurdles Bitcoin needs to overcome. One thing is certain. Bitcoin has etched itself in the annals of financial history and has set the stage for a future that promises to redefine our relationship with money. This is the world of Bitcoin today, a world that's continually evolving, continually surprising, and continually pushing the boundaries of what's possible.